Okay, everyone see the slides?
Yep.
Yes.
Okay. Okay, I'm gonna probably go fast and furious. I think what we're gonna do is submit questions in the chat. Ross is gonna keep an eye on that. I'm gonna do a few slides and then we'll have a little pause for any clarification questions just to make sure that you're tracking with me. And then I'm gonna do a little more about the ERTC and PPP interaction, which is sort of like the intermediate step. And then we'll have the time that's left for Q&A at the end. So first of all, I'm giving the obligatory disclaimer because Rob Cohen has trained me well, and this is informational, and I am not giving you advice for your company. You should talk to your CPA, your payroll processor. Those are the two people I was specifically talking to, or your attorney to get any advice for your company. So I want to start by talking about, why should you bother going after this credit? Because I think many of us have gotten PPPs and you're going through this huge application process. Obviously, that money was very helpful. This is just another thing that may feel like, oh, it's just, something else I've got to do. But I want to explain to you why I'm an evangelist for this. And I really think everybody should go after this. Number one, it's available. It's already law. All this work that Chris and Dasher and EDPA and other organizations are doing to try to get us in, getting some laws passed and getting us in the shuttered venue operators grant. Those things are wonderful and they would be a big help, but this one's already there. And companies who had in 2020 or had in 2021 a PPP loan are now eligible. In the original CARES Act, companies with PPPs were not eligible, which is why none of us, or why many of us didn't pay attention to it. But we now have retroactively become eligible. It is also immediately accessible by not paying your federal payroll taxes. Now, those of you who are in accounting say, wait a minute, we're not supposed to ever not pay our federal payroll tax deposits. But in this case, you can stop. That is how they have structured this, is that it gets the money most immediately into our hands that way, just by not paying those payroll tax deposits. So you could start next week getting some of this credit. And then it's retroactively accessible. So back to March 13th of 2020, where you're qualified, you can amend the 941s, which are the quarterly payroll tax returns, and get a refund on what you would be owed. So it goes from March 13th, 2020, all the way through December 31st of this. So you are able to access all of that. So you can start now moving forward and then do retroactive for what was already passed. It is easy. There's no application. There's no forgiveness. There's no waiting for approval. I don't know if you guys know this. I just read yesterday about the shuttered venue operators that there have been 13,000 applications for it and 1,500 have been approved. So there's a lot of people. It's moving so slowly. They're still waiting. And while I'm sure we would love to still be included in that, the downside is that one is really dragging, and this is easy to just start anytime. You don't have to submit any documentation. I would suggest still making sure you can produce a paper trail if you had to, but there's nothing you have to submit up front, like we've had to submit tons and tons and tons of documentation with our PPPs. There is really minimal tracking and calculating, especially if you have your payroll processor handle it, which is, we started doing that at the beginning of Q2, and it is easy as pie. We just, checked the box and it started happening, and just rolls along smoothly. Now, if you also have a PPP or had one in 2020, you're going to use it for that period, there is some strategic thinking effort that may be, not super easy, but also I think not too hard, that is beneficial to maximize your total relief available. And I'll talk more about that when we get to that part. And then also, we need this. This is substantial money. It is up to $33,000 per employee. So if you had an employee who makes more than $40,000 a year that has worked all through the pandemic and will through the end of this year, you are likely going to get $33,000 for that person if you did the retroactive and the moving forward. It is a nice chunk of change. And there's no cap on it. It's per employee. There's no limit other than making sure that you're within the employer size limits, but most of our industry is. It's a really great chance to refill your pockets. We all tapped into whatever retained, earnings and savings that we had for the last year and a half. And now we're about to restart this crazy, trade show machine. And we all know there's a lot of cash up front that you need for it, for show service orders and things like that. So this is a good chance to get some cash back into your pockets for that. Also, and this is a point that I've made to several people, that if you really are feeling like, I really want to recall some employees that I laid off, or I want to hire some people before things get going, but I don't want to not have enough work for them. Well, this credit is a great opportunity to have their pay partially covered, so you can afford to not completely be able to cover the workload. Maybe they can do some sort of retraining to get back up to speed, do some ramp up, maybe some inventorying. So it's really a good opportunity to build your employee base back up a little quicker than you otherwise might. Okay, so let's talk eligibility. And I see this in two steps. And I call step one the when. So there are two things that they provide for, and I'm going to touch on this first one, but I don't think this is the one we really need to pay the biggest attention to, but I just want you to be aware of it. It is whenever you are subject to a COVID suspension by government order. Obviously, our industry has been. So that does apply to us, but they're very specific about it applying only during the exact dates that you're shut down. And the whole government order shutdown is kind of fluid in our industry, because does it apply to where your company is? Does it apply to your clients' trade shows? What does it apply to? And we've had some opening up even since last year, state by state, city by city. So I think it's a harder one to deal with, and I don't think we need it. The one we should be paying attention to is the revenue reduction. So this is based on your qualification and eligibility to take the ERTC is based on your gross receipts declining compared to the same quarter in 2019. In 2020, the metric was that they had to decline by 50%. In other words, you could do no more than 50% of your 2019 revenue for that quarter in 2020. In 2021, they sweetened the pot and they said you only had to decline by 20%, meaning your revenue could be 80% of that same quarter in 2019. So, for most of us, that probably started back in Q2 of last year. Some people maybe even Q1. And it has probably, is still the situation for most companies in our industry. The gross receipts are calculated by your normal accounting method of your revenue. So, if you do cash basis, if you do accrual basis, all of those ways are good as long as you're comparing apples to apples. And it does not include any stimulus funds. So if you had a PPP or an EIDL loan, you don't have to count any of that in that revenue. So your eligibility starts with the first quarter that you are below the threshold, which, like I said, in our case, probably everybody was eligible as of Q2 of last year. And it stops once your revenue rises above the threshold. So basically when you get above 80% of the same quarter in 2019. Well, I would bet that most of us have not even gotten to that point yet as of Q2. And I think the likelihood for Q3, since things are just getting started back up, is pretty small, maybe Q4. But really the practical meaning of this is if you have been eligible all this time and you remain eligible through Q3, meaning you stay under 80% of your 2019 Q3 revenue, you will be eligible for Q4 no matter what, because it's always, you get the next quarter also. So that first quarter that you become ineligible, it still counts. It just doesn't count after that. So the trick is, it's counterintuitive, but if you're under 80, you kind of want to be under 80% of your revenue for Q3 in order to stay eligible for Q4. Now, granted, trade shows come back like crazy. Well, that's even better than getting this credit, but so far as getting the credit, Q3 is really the magic quarter. And then there are some special rules for businesses that started after 2019. I'm not focusing on any of that because I don't know that really applies to too many companies in our industry, and certainly on this Zoom today. So that is the eligibility of when. I think it's probably safe to say that most companies in our industry and in our EDPA membership are eligible and have been consistently since Q2 of last year, and probably will be till the end of this year, which is when it ends, and I can't imagine that they'll extend it further. So step 2 of the eligibility is how much. So once you're eligible from the revenue standpoint, then it's based on your employee size as to what you can count. And it refers back to 2019, and I put the calculation in here, but I'm not going to really cover it. I've made a PDF of this available to Ross and Dasher. I'm not sure what the plans are for posting that or sending that out, but you can refer back to it. But basically, in 2020, the maximum number of employees was 100, and in 2021, it's 500. So if you were under 100 employees in 2019, you were able to take this credit in 2020. If you are under 500 employees in 2019, you can take this credit in 2021. And that means, and when I say you can take it, that means you can take it for all the wages you paid to all your employees, no matter what. If you are over the maximum, you can still claim any wages and healthcare you paid for people when they were not working. So like, let's say when the shutdown started happening, you paid people for a couple weeks, or you kept some people on furlough and continued paying their healthcare for a while. That would still count if you're over those numbers. So just to give you an example of that, my company had an average of about 145 employees in 2019. So we were not eligible in 2020 to take it for all of our employees who were working, but we could take the healthcare that we paid to people who were furloughed and who were not working. In 2021, because we're under 500, we can take it for everybody. So that's how that works. I would think, most companies in our industry are probably going to be able to take it consistently. There are a handful of us who are over that 100 mark, but under the 500 that could only take the non-working wages and healthcare in 2020, but then can take everything in 2021. A couple notes, there are some things about control groups, so in parent subsidiary relationships. I didn't really get into this that much because it doesn't apply to us, but if you are in a situation in your company where there's parents and subsidiaries, I know they combine the employee count limits for that 500 and that 100. So you'd have to look into that one a little bit more and make sure how you qualify. And again, there's some special rules for businesses that started after 2019. So that's the eligibility. And then how much can you get? Well, in 2020, and this was in the original CARES Act last March, it is 50% of wages up to a maximum of 10,000 in wages, which means basically you could do that math, and you could get a maximum of $5,000 for the year per employee. Then when they updated this and extended it in December of last year, and extended it for in December, they extended it 2 quarters into 2021. And then in March, they extended it for the full year with basically the same rules. And that is, you can, in 2021, you take 70% of those wages up to $10,000, the first $10,000 of wages. And so that max is 7,000, and that one's per quarter, not per year, per quarter. So you can get 28,000 per employee, and that's where that total of $33,000 comes from. bonus for that they passed in March for Q3 and Q4 this year. If you are in a situation where your quarter over quarter revenue, compared to 2019 declined 90%, then you're considered severely distressed, which means you don't have that $10,000 cap. You get the 70% on each person's wages, no matter how much they get paid. So of course, for our industry, by Q3, Q4, trade shows are going to come back enough that we're probably not going to be under 90%. We needed that the last several quarters, but anyway, I just wanted you guys to know about that. This does include group health care. It's not just wages paid in cash wages. It's group health care for medical, dental, disability, and life, the same as a PPP. So that would count in this. So let's say you have somebody who only makes maybe $35,000 a year. So they're under that $10,000 per quarter, but the healthcare might boost them up to the full maximum $10,000 level. And again, you can use healthcare for furloughed employees. So if the company's paying healthcare for them, even if they're not getting wages, you can count them. It does not include owners who have more than 50% of ownership. I know that for sure. There are some other rules surrounding owners' eligibility. If there's an ownership, group, I don't know all the rules about that because again, doesn't apply to me. So I didn't completely pay attention to that piece. So that is something you would want to check out. And then also there's a whole slew of relatives that can't be covered. So if you've got, children, parents, brother, sister, working for the company, they may not be able to be covered. So that's something you'd want to check out. I think the government's logic was, well, we don't have to incentivize you to keep your owners and their families working. And then also you can't include any wages that were already credited from the FFCRA, which is like where someone's quarantined for COVID, you still pay them for up to 2 weeks and you could get that credit back from the government. If you have any of that, you can't count that in the wages covered by the ERTCs because you can't double dip. How am I doing on time? Okay. Okay, now how do you get it? Well, retroactively, because of course we're already in the middle of 2021 and this goes back to early 2020. So how can you get it retroactively? Well, you just file an amended 941, which is the quarterly payroll tax return. It's called a 941X, and you file that for each completed quarter. And I would suggest talking to your payroll processor or your CPA for help with that. I have heard, it's probably been a few weeks since I heard this, but I heard refunds are running about 2 months on that. You can also get it in advance. They have a form 7200 where you can estimate the amount of credit you should be able to earn based upon how many employees you have, how much they make, and so forth. And then that is reconciled at the end of the quarter through your 941. But early in the year, I heard that was running really well. Now I've heard it's really slow, like up to 6 months. So I can't say that I recommend that. My company's not doing that. We're doing the retroactive 941Xs and what I call the contemporaneous version, just stop paying your deposits. And that's immediate cash savings. So instead of making your payroll tax deposit with each payroll, like we typically do, especially through payroll processors, just stop paying it. And most payroll processors have a means of making that happen. And I would say that with the beginning of the third quarter coming up, it's a good time to start with that first paycheck, because since this starts over at the beginning of every quarter, it's, I think, the easiest way to track it. And all you've got to do is talk to your payroll processor and find out how to turn it on in their system. We use Paycor, and it was a pretty simple process to do. And like I said, now it's just rolling. And then at the end of the quarter, your 941 will reconcile it, and you'll get a refund back for any excess that exceeded those weekly deposit amounts. Because it probably will be, especially at the beginning of the quarter, your credit that you are due will exceed that tax deposit amount. And so you'll get that back at the end. Okay, so now this is where I want to take that pause for understanding. I've just thrown a lot of information at you. And if there's anything that just completely didn't make sense and you're lost, jump in now. And Ross, if you've got any from the chat, and then we'll go on into the ERTC and PPP interaction. So questions?
The only thing that's listed, Chris had a question, but I think he kind of maybe covered it. Is he said, is this best analyzed quarter by quarter, not annually?
Yeah, I think you did cover that already.
Okay.
How does it affect when, so, we're a labor company, so the majority of our employees are contract labor. Is this only for full-time labor? And how would that affect our numbers? I mean, we do pay, they get we take taxes and stuff out of their checks, but do those people count towards our 100 people, or is it just our core people who get insurance and all that stuff? Do you have any idea?
Because it doesn't apply to my company, that's not something I delved into. I think generally contractors don't count in this. I think certainly from the standpoint of your eligibility and your numbers, from a credit standpoint, I honestly don't know. If you're paying their payroll taxes, it is possible. So I think that's a good question for your CPA.
So yeah, I just wonder if we have to count it like the number of hours per year as a full-time person, because I may employ 600 people for the year, but some of them are, for a day because they worked at one particular show, or, they only work a few hours here and there. So,
right. Just real, I'm sorry. This applies to us a little bit. I'm interpreting, Matthew, there's two parts Kelly talked about, but when you talk about how much, she said, you want to refer to your average number of full-time employees in 2019. When you filed your PPP, or when Amanda did, I'm assuming, we had to do full-time employee equivalent, right? FTE. So we all took those. If they're run through your payroll, they're an employee on those days that you run them through your payroll.
Right.
That's usually union contracts or union workers are going to be required. That requires it. But if you're running them through payroll, they're an employee. So you add up all the hours, and I think for us, it ended up with, we may have been 31, but we were 41 full-time employee equivalent. When we add up all the numbers, divide by 30, right, which was, the number for a full-time equivalent. Anyway, you do the math that way. So I think that's what you could use to say, okay, what's the max we qualify for? I think on the credit part, what I'm looking at is anybody that you've brought back once you got PPP money that was listed as full-time employees. Now, Kelly's right. The question I would have is, she mentioned if they're furloughed and you're paying maybe some benefits, but they're not on your payroll, they may qualify if they're a true employee. I don't know how that works, but I don't know that you would have been paying their benefits, right? If it was, maybe you were, but
yeah,
there may be something there, but I think that the thing you're looking for is, are they classified as employees because they've been run through your payroll? If you're paying them, a different 1099.
I think that you answered the question. I think with full-time, it's full-time equivalent. So yes. It would be 40 hours a week times 52 weeks.
It actually isn't.
It isn't?
I came back to the slide that I had and I kind of glossed over this, but what this one is different from the PPP, and it is anybody who has worked an average of 30 hours per week or 130 hours per month. So, add them up for the year and divide. You do not need to add part-timers together to make a full-time equivalent out of them. So if you have two people that both work less, you don't lump them together. It's each individual person.
Okay, so if they don't average 30 hours per week for the 52 weeks of the year, then they don't count as a full-time employee.
Correct. In this, that is my understanding. Now, I'm going to say double check that with your CPA, because again, we don't have a lot of that, so I didn't really focus on it, but I actually took this right out of the slide from another webinar that I took, which is, where I learned a lot of information.
Well, that's huge, because that would really help, like I said, like like Chris, we employ a bunch of people when we have a lot of jobs at a show. So we absolutely employed over 100 people in 2019, but they weren't all full time. So that really helps clarify that for us. So,
And I will say, and I will say too, I completely agree with Chris on this. If they, for whatever time they are run through your payroll, I think they count. So again, double check that. But I would say if you're not giving them a 1099, if you're actually running them through your payroll, they should count. Not talking about this averaging, but I'm talking about taking the credit when I say
right,
that.
right.
Okay.
Do
So
you know where we could find guidance, Kelly, on things like the family members that might be excluded?
So it's pretty easy to find online. You can look at there's IRS notice specifically about it. And I think it's 2120, I believe is the number, but I'm not sure. But I will tell you this, reading any of the IRS's documentation is a pain in the ass.
It's a punishment, really, is what you're saying.
Yeah, exactly. I mean, sometimes it's, I mean, I've learned much of what I know from the webinars that I've taken, and I've looked back at the IRS notices from time to time to clarify something, but it is there. But I think even, I would start with maybe some Google searches and just say, what, eligibility for ERTC or family member eligibility for ERTC, and probably a lot of articles will come up. That's where I would suggest going first, is your CPA or other accountancy sources that you use for things, because they have already read this stuff and interpreted it for you. And I find those a lot easier to read than than reading the actual IRS stuff. If I will look, if I see if I have anything, I can let you guys know. But I remember when a lot of the information we got about the family in some of the webinars that I took about the family stuff, there was a lot of conflicting information because I think it was still kind of unclear at that time. And so I didn't really want to say too much about it because or provide any of those resources because I'm not really positive that they're right. So I definitely will look at something recent if you find something. All right, any other burning questions right now? Okay, then we will jump into the ERTC and the PPP. This is where it gets fun for the math geeks like me. Okay, so you can claim the ERTC during your PPP cover period. I think a lot of people think that, oh, if I have a PPP, whenever I'm using the PPP, whatever my cover period is, or however much of it I use, I can't claim the ERTC during that time. That is not the case. That may be the cleanest and easiest way, but that is not the case. You can take them both at the same time. In a given single payroll, you might have some people applied to the ERTC, some people to the PPP. You can actually even split an individual's wages, where some of their wage, maybe they max out 1 week without using their whole paycheck. And you can take however much you need that maxes them out to the ERTC, and whatever's left, you can put to the PPP. And I call this slice and dice the payroll. I took that from a webinar that actually I provide as a resource later. As long as you don't double dip any payroll dollar, you can do whatever maximizes it for you. And I will tell you, when I first started in January watching webinars about this and started first realizing that, oh my gosh, this applies to us now. I thought, oh yeah, I'm gonna get my PPP over with as fast as I can and then take the ERTC. And then I saw this webinar about the slice and dice method. And I thought, is this going to be worth the work to check it out? Well, it totally is, because it probably increased my ERTC credit for Q1 and Q2, which is all that was, there at the time. It probably increased it by 50%. to
Wow.
kind of analyze that slice and dice. So well worth it to really think about it. So I'm going to give you some recommendations and a little sample of how you can look at this. But I did want to mention one thing I do know for sure. If you have already submitted your forgiveness application for a PPP, maybe last year's, because probably none of us are quite done with them this year. But if you already submitted your forgiveness application, you are stuck with whatever amount of payroll you claimed. So let's say you submitted it and maybe it's forgiven or not, but if you just submitted it and you put way more payroll into it than you really needed to, well, you can't now go back and redirect any to the ERTC. You're stuck with whatever amount you said. But you can look at it differently for if you have one in 2021 that you still haven't applied for forgiveness, you can apply some of these tips. So my suggestion is to sanity check it first. Everybody, we're all going to be different. Every one of our companies is going to be different. You've got to look at what is your PPP loan size? And then of course, how much payroll do you have to put in your forgiveness? Because there's a 60% rule that 60% of your forgiveness has to come from payroll. So you've got to look at that, and you got to look at your current payroll level. How much are you going to be able to apply to it from your payroll? Do you have, way fewer employees than you had in 2019? Do you have more? So you just have to think about, what your ability to accrue that payroll is compared to your PPP loan size. As a hint, I would say you want to use all 24 weeks for your PPP. Even if you could do it sooner, you can get more non-payroll items, more utility bills, more operational expenses, things like that if you go longer, which will give you the ability to use no more, as little as possible, more than that 60% requirement. Let's say though you figure out that you can't, that you need, you can't maximize, you don't have enough payroll to maximize both and get your full 7,000 per quarter out of every person plus satisfy your PPP payroll requirement. Well, then you've got to decide, do you want to skew, and I'm not advocating any choice. I'm just saying this is the decision. Do you want to skew to the PPP to ensure you get full forgiveness, which is kind of what, everybody, drills into our heads is, oh, get full forgiveness, get full forgiveness. But, there is the option that if you're okay with having a loan on your PPP, you could short your payroll on your PPP in order to direct it to the ERTC to maximize it and get more cash now. Yes, down the road, you're going to have payments on the loan, but you've got to think about your situation and how much do you need every dollar you can get your hands on right now, and you'll pay the piper a little later on. So again, that's an individual decision that everyone wants to consider, but I know that, it's been sort of drilled in our head, get full forgiveness, get full forgiveness. Well, there's no law that says you have to get full forgiveness. That is your choice. So think about that when you're looking at the ERTC, and think about how much you need that cash right now. So to me, the maximal interaction, in my Math Geek opinion, and this is the way I'm doing it, is at the beginning of the quarter, starting at the beginning of the quarter, you're applying a person fully to the ERTC until they're maxed out. And this is the way, at least our payroll processor does it. They just apply the person's payroll completely to the ERTC. And then when they max, then it's, it's partial 1 week when they hit the max, and then it's 0 after that. Well, once they're maxed, then apply the rest of it to the PPP for each person. And that is the way to get the maximum, provided, you can meet both. Otherwise, you've got to make a choice and decide which way you want to go. Now, like I said, we started, because I did my sanity check early on, in Q1. I knew that in Q2, I knew we could turn it on with our payroll processor and I would be covered and we would be safe letting that happen. But if you're not totally sure, you don't love doing math, you want to, not bother doing that, wait till after your PPP is done, wait till after your cover period and you're getting ready to apply for forgiveness, and then calculate it and think about it. Of course, that's going to delay your getting the cash, but that is another way to go. Or you can just wait till it's all done and you've got actual figures in front of you and then start slicing and dicing it. So now I'm going to show you a little spreadsheet I made up. It's going to probably be very small and I can zoom in on some parts, and I'm not going to really focus on it because, again, I want to definitely allow time for questions, but I just want to give you a flavor of what I'm talking about when I say sanity check. And then even for tracking, how this can be done. Okay, let me zoom in on this. Okay, can you guys see that okay?
Yes, it makes me very happy.
It makes me very nervous.
Yeah, I'm getting no tingles at all.
Yeah.
Spreadsheets. Okay, so this is just a real rough that I did on really just the first, I took it from the beginning of January to, I did one of these little boxes for every week, if your payrolls every week, and did it through like into July a little bit because I had room for that. So this really represents a little over half a year. So I've got Q1, Q2, and just the beginning of Q3. And I've got an owner in there, and then I've got 4 employees. And just showing you from week to week how this interaction can work. So I'm just going to start. And obviously here, I've just got everyone's annual divided by 52 to get a weekly. Obviously, hourly employees are going to change a lot. It's going to be variable. You may have commissions, you may have some bonuses, you may have different things. It's always going to be the actual pay for that week of the person. But for my example, just to keep it simple, I've just done, evenly divided by 52. And so, first few weeks, so this PPP, I actually use my dates, which was January 26th to July 12th. Well, the first 3 weeks of January, PPP didn't exist yet. So everyone's going to the ERTC. And then on the 29th, no one's maxed yet. So even though my PPP exists, no one but the owner is going to it because the owner isn't eligible for the ERTC. So they can go totally to the PPP. And then we come down to the next week and we're going along. Well, here you see this green line on February 19th for the first employee. That 1346 made them hit the $10,000 max. And actually, you can see that's why I've used the green here. Well, there's $96 left. I applied that to the PPP. So keep going. Now the second employee has maxed. Well, they actually didn't have any extra because their wage is perfectly divisible into 10,000. So there was nothing left, but the next week they're going to the PPP. And that first employee is going fully to the PPP at that point. So now I've got a couple employees going to the PPP. I've got some employees who haven't maxed yet, still going to the ERTC. We get down here last week of the quarter, of the first quarter. This person, employee number 3, had a little bit left to max out the ERTC, had a little bit left over that can go to the PPP. Fourth employee never hit their max because they make less than $40,000 a year. Now we go to the next quarter, we start over again. So now the $10,000 wages keeps ticking, or starts over ticking. So same thing happens. You're just max, just putting people in the ERTC until they max. So you'll see the same pattern. This 1602 for the owner is just because for PPP, the owner can only get 20,833, I think, in the PPP. So that's max there. And then you see there's 0 after that. But so keeps going in the same way. Third quarter starts over again. So if we come back to the totals, and again, this is just barely over half a year. With just 4 employees, I've got $63,000.
Yeah, that's awesome.
Now, does this, I've only got just under 50 going to the PPP. That's where the question comes in of, okay, is 50 going to cut it? Because my whole PPP period is contained in the spreadsheet. Does 50,000 cut it? Does it meet my 60% rule and get me my total with whatever non-payroll items I have? So you have to weigh that. If it doesn't, then you can think about, well, I really want to max my PPP. I want full forgiveness. I don't want to have a loan. So I'm not going to be able to max everybody in my ERTC. And maybe, you don't count a week or two. You take a couple weeks of payroll that you just give all of the PPP and you just run short of the max on some people for the ERTC. Or you say, hey, I really needed 70,000, making up that number for my PPP, but I'm okay having a $20,000 loan to get this whole 62. And so you just have to play with the numbers and see which way you want to go. So that is there for you to look at and have all kinds of spreadsheet fun with. Okay, so I think I need, okay, there we go. Okay, so then also this again is in that PDF, just some resources for you that have been very helpful to me. I am a member of NFIB, which is the National Federation of Independent Business. If you haven't heard of it, I know at least one of you here is a member. Chris is smiling. It is essentially a political lobby for small business, but they have a small business legal center also that has just been wonderful, doing weekly webinars on all the government relief topics since the beginning. So they've had just a lot of wonderful webinars. I've got the link there to their overall coronavirus help site. They've got all kinds of calculators and things like that. But then the two webinars that I've thought were the absolute best ones that they had, I've got those links. You may have to, if you go to them and want to watch them, you may have to like put in your name and email, and then you'll probably start getting promotional things afterwards. But actually, I gotta say, great organization that you might want to consider paying attention to anyway. I've also put in for a link for GBQ, which is another accountancy site that I've used a lot. And then I wanted to put in a link for SCORE, because if you do, if you need help and you don't really have accessible help with this, SCORE can be a great resource for you to have somebody to help you walk through this and make your spreadsheets up. I also put in my email address. I will be happy to help answer questions, but I'm going to say try to keep them pretty basic. If they get really granular about your business, I'm probably going to say, what I said to Matthew earlier, which is you really need to talk to your CPA, because it may go above my pay grade in being able to help you. And I sure as heck do something wrong. I wouldn't want to get you into any trouble, but I will do that. And then also just, I don't know how many questions I'll get, so just be patient with me on response time, because as you all know, I got a day job too. So I think that is probably, yep. And so any further questions? And like I said before, I'm good to go for as long as you guys want to chat. So, and actually I'm gonna stop sharing. Well, I'll leave it up in case we got to go back and refer to something. So
Amy asked if you were going to share this spreadsheet.
it is in the slides. Ross, Dasher,
Okay.
you guys have plans to provide that PDF to people? Okay, it is in that.
Perfect.
I'm going to say you don't necessarily, I don't have the Excel document in there. It's just you see it in the PDF, because I don't necessarily think it's going to be that spreadsheet is necessarily very conducive to actually your spreadsheet for your company, because you're going to have a lot more employees. It's not really conducive to inserting rows or columns. You'll want to have a good, employees across the top or down the side and dates on the other, and not those little boxes the way I have it. But at least it'll be there as a reference for you.
I'm just wishing we had you at Engage few weeks ago. I'm just thinking about so many of these business owners. But at the same time, this is something that can be done retroactively. So
Yeah.
there's plenty of time to evaluate and do it.
Yeah,
You did a great job. You just broke this down in very snackable bites. And I think each one of us, even with different circumstances, can go back and kind of check. And you've been preaching this to me for months that you got to look at this, and I totally see it. Right. I really do. This is great stuff. Thank you.
I would say the jewel for me is, so we're doing this already. I'm already doing this with my CPA, and actually we use Zenefits as a system, and they are so bogged down. So getting the 941s sort of restated, they have the whole package, but it's delayed. But the jewel for me on this, and I appreciate it, Kelly, is that balance between, do I want, any business owner can say, would I like to take advantage of every possibility to offset the impact of the last year, which is gross dollars, or any variation of that, right? Because you really are saying, the cool thing about this is you can do what's good for you, right? I mean, someone who doesn't want to carry into a low interest loan in the future, that may be their driver, or all business owners are different, right? But this allows, it's not an either or, there's really depending on the number of people you employ and what the rates are, there's a lot of freedom to do this, and then also be able to do it on the back end if you choose. Like I was already planning to start doing something like you're doing, but now you just catapulted me forward in the beginning of third quarter with the payroll. So it's so much appreciated. I just wish there were 100 business owners on this call, but.
Well, the fact that it's recorded, right? They can hopefully pull this up. One mention that I'll give just to round out what Kelly was saying was, if for whatever your circumstances are and you choose to not max out PPP forgiveness, so you're gonna, you take the dollars by way of the ERTC credit, but if that leaves you with a loan on some of the PPP funds, just to be clear, that those funds, I believe, are paid back within 2 years. And Kelly, you may know that off the top of your head, but it's at 1% interest, right?
Yeah.
So you're talking about
now.
a
I think
1% interest loan, which is, it just, there may be circumstances where if you need that cash, that's a pretty affordable way to kick the can down the road 24 months, right?
Yeah. And I think it's 5 years, Chris. I don't know if you guys.
Is it 5? Oh, okay.
I think
Well,
it
you
was
may be right.
2 when the CARES Act passed, but
Yeah.
then I think the Flex Act took it to 5. But
It did. Okay. Well,
can't-
phenomenal.
But it's not prohibitive at all if you need to go that route.
Well, I officially say that you should take the rest of the day off.
Oh, thank you. I appreciate that. But no, I'm with you guys. I've been amazed how many people I have talked to, Chris being one of them. I'll kind of throw him under the bus on this, although he kind of alluded to it, where I've said, take this, look at this, do this. And it's like, oh, I'll get to it, or I haven't really yet. Yeah. But Chris is, I mean, I've talked to a few people in our industry who've said that, and I'm like, come on.
So just my guilty with an explanation to proving Kelly's right. So we ran out of PPP1 money and whatever savings or other cash we generated September 24th. So I literally had people, I had unpaid volunteers working. We thought we would see PPP2, within 30 days, and then another 30 days. We did not fund in PPP2 until March 15th. So that was literally, 6 months later, and so now, the light bulb going off over the head, which you can see here it's in my glasses right now. So, we just didn't have to suffer as much. There could have been relief there for us. So yeah, shame on me.
Okay, you're forgiven, but yeah,
It's not like you were busy doing other things.
Yeah, exactly. Yeah. And that's partially my fault too.
Oh, well, I have my, my finance manager, Donna Miller, is on this call. I know she's lurking very quiet there, but she's going to get me after this go, you idiot, right? Not that Donna doesn't say that to me, regularly, but yeah, this would have been, we should have paid attention to this.
Well, like Michael said, it's retroactive. So even though it may take a couple of months, you can do that. You can file for that. But start, like I said, start now. Start the third quarter, and even if you've got a paycheck left to go in the second quarter, you could do that. But if you're going to be if you're going to also do the retroactive, that's why I advise starting with the new quarter, because then you're clean and you're not using both methods trying to. So start with the third quarter, and then you're going to get thousands of dollars back, almost your entire payroll, because in the especially if you're going through a payroll processor, because in the beginning, no one's maxed out in that first week. So your entire amount that you'd be paying for your federal taxes, and that's your full tax payment, that's the income tax withholding, FICA, all of it. You probably won't pay anything for a few weeks. So that is just sheer savings right off the bat while you're doing that paperwork and waiting for those refunds. And then you can turn around and pay it all on show service deposits.
There you go. We like
Kelly, what I
all
didn't
speak
see,
the
when
same
does this
language.
end? Is this through the end of this year or?
It is through the end of this year, which is why, and like I said, if you're under the 80% mark in Q3, then you're automatically in for all of Q4. So that, and then it won't matter what happens in Q4.
And they're looking back at our 2019 numbers, right?
Correct.
And I think this is what I was thinking when I typed that question earlier. So it's literally quarter by quarter. There's no looking at worst quarter comparison, and that covers you for the year.
Right. Now, there is something, and again, I haven't paid a ton of attention to it because we completely qualify, as I believe most of our industry would, on taking, whatever quarter it is and going back to 2019. There are some provisions for you can compare to like the previous quarter and some other stuff. I don't even know that it really applies. To me, I'm just keeping it simple and saying you're comparing your current quarter back to 2019. But I mean, what we've been through, that should be enough. I'd love to meet whoever, has had higher than 80% during that time.
But even with a serious uptick this quarter for us, I'm comparing it to Q2 2019, which if I read, if I'm understanding you right, as long as I'm down 20% this year, right, we would be eligible.
Yep. If you did $1 million in Q2 of 2019, you can have up to 800,000 or just under 800,000 in Q2 of this year.
This is crazy. You know what it is? I'm realizing how skewed our thinking is, because I feel like we really picked up this quarter, but it's an anorexic quarter compared to where we came from, right? This is just compared to 2020, it feels like we're on fire, but we're really not.
Yeah. Well, we've all scaled back so much that, I see how it does feel that way.
Yeah. First and second quarter this year don't even qualify or aren't even close to what we do in July of a normal year, which is our slowest month. So
we've not all scaled back as well in the adult beverage category that you built.
yeah, that was my next question. Where is the employee alcohol retention credit?
Yeah.
That's what I want to know.
So now we're moving into my situation sucks more than yours does.
All I can say is I am very grateful to have a job.
I'll play that game, McMahon.
Amen.
If you want to go toe to toe.
I'll tell you, I've been really, really happy to see how many companies in our industry have managed to make it through this. I mean, I really thought that once PPP money ran out last year and all that, that we might, unfortunately, see people drop like flies, and it's really great to see the resilience and the ingenuity that obviously has been there to keep things going for everybody.
Yeah.
I agree. I think for some people, I was talking to Chris the other day, and I was saying to him, one of those nightmare days would be like, how much does it cost to get out of all this? If you decided you were just bagging, it still costs money, right? So those companies, the ones that didn't make it, hopefully they got picked up by other organizations. But I agree with you. When we went to Engage and you got to see all those people, I mean, you're like, wow, there's people are going to make it. There's a bunch of companies that are going to make it. It's good.
I'm gonna do it. Dasher, this is a question for you. I've got a 4:00 call with the Northeast chapter on kind of an update on some recovery stuff, but I want to plug them watching this. When do we think this might be up on our EDPA site where they could access that? Do we know?
Probably within the next week.
Next week? Okay.
Yeah. So Ross will get me the download, and then we'll get it up on there. So
All roads lead back.
Imagine
to
all the
Ross.
royalties for Kelly.
You know what? Once you've been EDPA president, the hat never comes all the way off. And and I'm happy to do it because, obviously, yes, lots of competitors in the industry, but we're a huge industry. I think that the rising tide lifts all boats in our industry, and there's lots of people who are our suppliers that we count on that I want to see be okay. So I hope everybody who I hope everybody takes this, because I bet just about everybody in our membership is eligible.
But you would like to see Dasher
Amen.
send out the EDPA member retention tax credit form.
Yeah, dude. Yeah, can I get a percentage? No.
Let's get on that, Carrie. Come on now.
You got it.
But I do like your Crown Royal purple wall behind you, by the way. I just
Thank you. Yes, I am all about the purple. Was he not here for the part we talk about it matches my cup and my glass?
I didn't see that part.
Yeah.
The background of my computer
Kelly is the
purple.
You're the most creative looking bookworm money person, spreadsheet person I've ever seen.
This industry will do that to you.
Yeah.
Kelly, if you need any Crown Royal bags to accompany anything, just let me know. I might have a couple of hundred. So
sounds great.
Well, thank you for doing this, Ms. Glazer.
Thank you.
are you going to get to come to Access in November, December?
Oh yeah.
Awesome.
I would have come to Engage, but I was on vacation last week, and I couldn't marry the trip before the trip kind of thing, especially because I had a webinar to get ready for.
Yeah.
Thanks, Ross. Dasher started it.
Michael started it.
Yes.
Yeah.
Well, you nailed it though. You knew when you put it out there that you would help out. We were going to pounce.
I knew that was and if I'm not willing to do something, I don't even volunteer, because I know.
Well, great job. I think this is going to have, there's going to be a ripple effect for this thing. I mean, if it's available to people, it really is. It's just a must see. And I love the way you package the information, because I'm a shiny object person and I could pay attention the entire time.
We're very proud of you, Michael.
Thank you. I'm doing my best.
Why do I feel like McMahon's going to just copy and paste this under the member recovery committee window and say, yeah, we're done for the quarter.
Yeah, we killed it.
This fits member recovery, man.
Okay, so you can all buy me a drink at Access. Thanks.
Yes, absolutely.
Done and double done.
Won't be a problem. You're
All right, I'm gonna
because
I'm
of your
gonna
lack
park.
of alcohol consumption, you're going to be such a lightweight at access that it'll only take one or two, and you'll be saying no more.
I gotta rebuild my tolerance before then. Last week with my parents in Sarasota got me started on the, on that path, so.
Nice.
All right, I'm gonna sign off, guys. Thank you for this, Kelly.
Thank you.
Thanks, Kelly.
Thank you.
Thanks, Kelly. Good seeing you.
We all done?
Everybody,
Yep,
Thank you.
thank you.
Bye.
good job.
Thank you.